Stock dividends can be hard to understand. The cash might look good in the short term, but sometimes a company's dividend might indicate that it's failing to reinvest in the growth of its business. Today we're going to talk about dividend stocks versus growth stocks. When a company pays a stock dividend, that means it's sharing some of its profits with the people who own its stock. And that can be rewarding for investors, but it also takes a bite out of the company's bottom line. Other companies really devote themselves to driving every piece of available cash they have into growing and expanding their business. Those are the two major distinctions between how companies decide whether to issue dividends or not. Before we get started, I want to note that I'm not a personal financial advisor. This is not personalized financial advice. But dividends, in a very general sense, are pretty easy to understand. From a personal finance perspective, you can think of them as a way to get cash on a regular basis from your stock investments without having to sell that stock. So if you were a person who owned your own company and you made money, you'd have to decide how you wanted to spend that money. You want to keep it and pay yourself salary, or do you want to invest it back in the company? You might decide that over time, your investment is going to grow more. What you put into that business is going to grow more if you leave it there. These are the same kinds of decisions that boards and executives at companies need to make when they're deciding whether to offer a dividend and how much to offer. Dividends for investors are ways to get stable and growing income over time. And broadly speaking, you're looking generally for a dividend that's going to continue to increase rather than going down. Now, lots of blue chip companies have dividends. They're not very uncommon. Here are some examples: Apple, Target, Exxon, CVS. So they're very easy to find on Wall Street. Advisors say one of the easiest ways to measure a dividend's safety is to check its payout ratio. That is the portion of its net income that goes toward dividend payments. If a company pays out 100% or more of its income, the dividend could be in trouble during tougher times. Earnings might not be high enough to cover that kind of payout. So generally speaking, investors look for payout ratios that are 80% or below. A payout ratio is relatively easy to find on financial websites or online broker websites, and there you can also find another piece of information that you can use, which is dividend yield. Now, this is a measure of the company's annual dividend divided by its stock price on a certain date. The dividend yield allows for a more accurate comparison of dividend stocks. So here's an example. A $10 stock paying 10 cents quarterly or 40 cents per share annually has the same yield as a $100 stock paying $1 quarterly or $4 annually. In both cases, the yield is 4%. Yield and stock price are inversely related, and that means when one goes up, the other goes down. So there are two ways for a stock's dividend yield to go up. The company could raise its dividend. A $100 stock with a $4 dividend might see a 10% increase in its dividend, raising the annual payout to $4.40 per share. If the stock price doesn't change, the yield becomes 4.4%. The stock price could go down while the dividend remains unchanged. That $100 stock with a $4 dividend might decline to $90 per share. With that same $4 dividend, the yield would become just over 4.4%. So another important thing to think about with dividends is the tax situation. When you get a dividend payout, it's generally taxable in the year you get it, unless it's in a tax-advantaged account, like a 401k. Now, that may be the case for a lot of different people, so this might not matter. But if you are using a regular brokerage that's not tax-advantaged, or you're in a high bracket, this could be a sensitive thing, and you might really want to think about whether you really need that dividend income this year. The goal over time is to grow the value of the money you put into whatever companies you're investing in. And whether it comes out once every couple quarters or whether it comes out at the very end when you're ready to liquidate your investment, what you're looking at is an overall gain. And so you want to think about how a dividend fits into that. And companies make the same kinds of considerations as we discussed. One example would be Disney. Disney paid out a dividend until about 2020. Now, a lot of companies suspended their dividends in 2020, but Disney hasn't put theirs back. And one of the reasons for that is Disney's doing a lot of investing in streaming. And that's important for media companies right now. And so their management has decided that in order to stay competitive, this is where they need to invest their money rather than giving it back to shareholders right away. Now, it may or may not work out, but they've made a case to their shareholders that this is the best use of the money they're bringing in at this moment. So this brings us to growth stocks. Growth stocks are shares in companies whose revenue or net income are growing faster than the market average. And growth stocks are often contrasted to value stocks, which investors hope will recover in value after some kind of recent setback, or income stocks, which generally pay dividends. Now, this doesn't mean that growth stocks cannot pay dividends. Some do. In fact, Apple is one of the primary growth stocks you hear about, and it also pays a dividend. But generally speaking, growth and income are different goals for an investor. If you've heard the term growth stocks before, there's a good chance that it was referring to large technology companies like Microsoft, Amazon, Tesla, Google. However, not all growth stocks are technology stocks. Growth stocks can be in the healthcare sector, the financial sector, or really any other sector. What defines them is growth. NerdWallet has a list of top performing growth stocks you can look at if you want to learn more. Evaluating a stock as a growth stock is a little different from evaluating it as a dividend stock because there's not as much math you have to do. Basically, you want to look at its revenue growth and its price performance and see, are those doing better than the market? Do you think they're going to continue doing better than the market? I'm going to give you an example. For 2022 in October, Vertex Pharmaceuticals was one of the top growth stocks of the year. 22.5% revenue growth last quarter over the same quarter in the prior year, and its price performance was up 31.85%. Essentially, in a year where the market's not done very well, that is a stock that is growing faster than the market in general. Now, the big caveat here is just because it did that before doesn't mean it's going to continue to grow faster than the market, right? That is the skill and the decision making that goes into finding growth stocks, which is you have to decide whether something that has historically grown well is going to continue, and maybe you can find something that historically hasn't that you believe will start to do that. So to tie it all together, there are two reasons you might pick a growth stock over a dividend stock. One is because you don't want to deal with the tax headaches, and the second is because you really feel that the particular company you're looking at would do better to push its profits back into its business. And a dividend can be a red flag one way or the other. You might be worried that a company isn't sharing the profit with its investors enough, or you might be worried that its dividend is too generous and that it's thinking short term and not thinking long term about how it could benefit from reinvestment. In the end, you're going to have to decide with each company you're looking at. Is this company better served by giving me the profits right away, or is it better served by continuing to invest in growing and expanding its business? I'm Andy Rosen, an investing writer for NerdWallet. If you made it this far in the video, it's probably a good time to remind you that even if you found a great growth stock or a great dividend stock, or maybe one that does both, it's always a good idea to diversify your portfolio so if one bad thing happens to that company, your whole portfolio isn't ruined. If you learned something today, please like and subscribe.